How are you doing today? Are you a young stock market investor? Because today I'm going to share with you guys 3 things I wish I knew before I started investing in the stock market. But before that, are you also seeking to be in the successful minority? Because if so, you need to subscribe to this channel because I'm going to be documenting my journey to that minority, the successful minority, from poverty to success. All my failures, all my successes, to where you guys can learn from them and also join the successful minority. Let's get right into the video. Alrighty, young investors. Tip number 1. You should be trading based on value. Don't be trading based on hysteria, what the news is saying, because most of the time, that stuff is already reflected into the price of the stock. It's not just gonna be like rise just because they're talking about it. That's not how it works. The market often reflects the price into a company as soon as that information is released. And the news outlets are not the first people that know about the news. So take that as a good note. Also, you should be trading based on the balance sheet, the PE ratio, all the homework you guys should be doing before you buy a stock in the first place. You need to be trading based on value, guys. Do not trade based on the chart. This is the first thing that pops up in most brokerage apps, and just don't trade based on a chart, because charts are a record. They are not a forecast. Remember that, especially if you're a young investor like me. It is a record. Okay? Record. Also, whenever you go to sell a stock, trade a stock, whenever you go to sell, you need to believe that that company has reached a point in the price that it's not valued at anymore. It's overvalued. That's whenever you should trade a stock and get out of it. You do not trade a stock because the company is doing bad, especially if all the homework you did proves otherwise, that it's going to be doing great. So you only trade out of a company whenever you believe the company has reached an overvalued price in the stock market. Just because a company does bad doesn't mean that you should be selling. Oftentimes than not, you wait a while, the company will always balance itself back up and the market will do good again. Another bonus for not selling whenever a company just does bad, most of the time, be collecting dividends. You won't have to pay capital gain taxes, and you also want to pay trading commissions. So there's a lot of value in just not trading because you're scared that a company is going to be dropping. Do your homework and everything will be okay. Just trade based on value. Tip number 2 is to diversify over time. Now, the reason I left a blank space is because I want to visually show you guys this and show you how this tip works. It's something great, and I'm so glad I learned this. I learned this in a book called The Only Investment Guide You'll Ever Need by Andrew Tobias. It's not promoted, but it's a great book, and I advise all of you guys to read it. So basically, Andrew says this, and it's been working for me with the stock AMD in the past couple months since I turned 18. I turned 18 in October. It's been 3 months. And I've already made gains on AMD based off of just this tip. So here we've got the price of the stock. Here we've got the time of the stock, T and P. We'll picture this as my name, Jonah, or J-N-A-H. We'll picture me as a stock, okay? And I hope you guys want to invest in me. Anyway, I'm gonna be freaking rich, freaking rich, freaking rich. No, I'm kidding. No, I'm not kidding. But anyways, so here we're gonna have the stock. Say you have the potential to buy 300 shares of me. So this is you right here. You buy in right here at this time, but you buy all 300 potential shares. Like you have this much capital to buy 300 shares of Jonah, me, that is. You buy here and then it dips. Most young investors will flip. They'll flip their bricks and sell out. So first of all, you're gonna be here and you're gonna be selling out here. Don't do that, first of all, especially if you've already made this mistake and you're going all in. You better be investing for the long run, especially if you went all the way in and didn't do any research. Unless you know this company is gonna go to zero, which the percent chance of a company going to zero just randomly after you invest in it is very slim. But just because it dips doesn't mean you should sell all out. I'm gonna just put that out there right now. But let's say you didn't and you invested the smart way and you seen Jonah, you did your research, you did the value, and you realized that you want to invest in Jonah. You put only 100 of the shares, you were potentially able to buy 300. You only buy 100 though. It dips. This is a great opportunity for you. Most of you guys should hope that this happens. So basically, the way a brokerage works is you have this price right here, and then you have this price right here. If you buy in whenever it dips, instead of only putting all your money in at one time and diversify over time, you put another 100 in here. Now guess what? Instead of buying here and you buy another one here, you get the average price here. So this is how much you're gonna have now. This line right here is how much you purchased the 200 shares at now. If I go up even more and then go down even more and say we're here, you're flipping your shit because this is really close to zero, but that's not the point. We're here at zero, you buy in more and you're here, you buy in here, you were there, and you buy in, you put your last 100 shares in here. Because this is actually great for you. It might be scary, but you need to learn to hedge against the losses. So basically you put your last 100 there, and you're gonna take, the brokerage is gonna take the average again. So guess what? Now, the price of your stock that you bought is now half of what you bought it at the beginning if you would have put all 300 shares in. So now, say Jonah, me in 3-4 years, bang, just bang. That doesn't normally happen, but in the stock market it doesn't normally happen. But that's just a visual representation of why you should diversify over time. Don't throw all your money in at one time. Now, let's get into number 3. And this is an obvious one, but most people don't do this, and this is how they acquire debt in the stock market. Only invest money you won't have to touch for 2+ years. At least 2+ years. First of all, the percentage of losers after 2 years is highly low. Highly low. Losers are around 30% in 2 years. But if you did your research, 100%, you'll be alright. I promise. But also here, only invest money you won't have to use. And basically what I'm saying with this, as young investors, you don't want to be throwing your month's rent into the stock market because you think you're going to make 6 months of rent in 1 month. That's not how the stock market works. Only with Jonah. Only with Jonah. That's not how the stock market works. You don't want to throw money that you're going to have to take out again because, say, most of the time companies will dip. And if you dip and you have to take your money out, you're gonna have to pay taxes, capital gain taxes. You're also gonna have to pay commission fees, and you're just gonna be losing an insane amount of money that you should not be losing. So if you don't have any money to start investing, guys, you should refer to those videos I produced at the very beginning of my channel. Now, this is the end of my video. Thank you guys for watching, and as always, keep grinding and keep growing.